Hi, this is Jim Cramer from CNBC's Mad Money. I want to talk about some of the common mistakes, 5 mistakes that almost everybody makes who's out there trying to figure out what to do with their money, particularly in this environment. And the environment I describe as being low interest rates, which we're going to have for a very long time. Our Fed chief, Ben Bernanke, basically has assured that. The first thing people do wrong is they don't understand that fixed income is producing no income. Right now, there's a perception that the safest thing you can do is keep your money in cash. But I've got to tell you, given the prospective inflation rate, given the idea that where you have your cash is probably going to be in a CD, a bank, a savings account, or a money fund, you're going to be making nothing. And that's not a strategy. That's a dangerous way to be able to run your money. So those who think that they can just sit in fixed income, whether they be treasuries, whether they be CDs, are making a very big mistake, because that's not a place for income. What should people be doing? They should be thinking about owning common stocks with good, safe dividends by companies that have very good credit ratings. And you can always check the credit rating. It's available at Yahoo Finance, visible. You can find it. It's visible on almost every single site when you talk about stocks. But what you're looking for is a company that yields between 2 and 5%. Why I say 2 and 5, I don't want to do more than 5 right now, other than on a case-by-case basis, because sometimes the ones that yield more than 5 are often red flags. But a company with a long tradition of giving dividends, Procter & Gamble, an Emerson, that kind of company, a Kinder Morgan Energy Partners, if you want to do a little bit higher yield. These are the kinds of stocks that historically have been terrific to buy. Verizon, AT&T, Con Ed, Dominion Resources, Exelon. Those are the companies that give you a good yield, and they have decent balance sheets, and those are far better for fixed income than having cash. And there is some upside, obviously, if the stocks can go higher. But these are companies that are serial deliverers of dividends. They like to boost their dividend every year, and I think that's a much better alternative. Yes, there's downside to stocks, but if you want to go to a 4 or 5% yielder in this environment, those are probably going to have a nice cushion if they do go down. Waste management, International Paper, these are examples of stocks that have higher accidental yields. I call them accidental high yields. Why? Because the stocks have come down so much. They never expected that the yield would be this great. People don't understand the power of compounding. Now, this is something that I think that I wish people were taught better at schools. But if you reinvest the dividends, which is the third misconception. People don't do that. They use the dividends for income. That's how you get most of your performance. More than 50% of the S&P 500's performance in the last 20 years has come from reinvesting in the dividends. Almost all of the appreciation that anyone has in the last 5 years has come from reinvesting these dividends. So the dividends are a vital component. The actual capital appreciation of stocks, they haven't done anything in 10 years. But if you own stocks, high-quality stocks with dividends, you've done much better than the averages indicate. Now, if you can't pick individual stocks and you don't want to be in a mutual fund, which I completely understand because most of the mutual funds have had very high fees and haven't delivered anything, then you probably want to go to see an advisor. And what I want to tell you about seeing an advisor is this. The moment you go to the advisor, a lot of people feel their job's done. They say, okay, well, listen, I've just been in. I did a lot of work with the advisor. The advisor's really terrific. I'm just going to turn the money over. That's okay, but I would tell you that the best clients are people who stay up on the advisor. So once the money is turned over, I don't think the process ends. I think it's a new and different process, and it begins. You have to monitor how the advisor's doing. If you don't like what the advisor's doing, you've got to speak up. If the person talks down to you, then you're with the wrong advisor. How do you find that right advisor? I like to go to a network of people who recommend people to me. And one of the reasons I like that so much is because that person who you're being recommended to will be somewhat on the hook to the people you went to, and therefore I think do a better job. Finally, I want you to be super suspicious of super high returns. One of the things that people have gotten wrong is they hear that someone's compounding it at 30%, or someone's making 35 or 40%, some number that seems so out of sync with what the S&P 500 is doing or what you can get in interest rates. And when you see that, I'm telling you, it's a red flag. You've got to protect yourself. I suspect that that is not a real return. One way to protect yourself is to be able to speak to the accountant that does that is actually meant to be the accountant for the public statements. Another way is to be able to look at the averages and say, geez, that's such a big difference. I'd like to know how the person's making their money. If the person doesn't tell you how they're making their money, then you have to presume that the person isn't doing it honestly. It's more important than ever to be vigilant. So just to review, fixed income is not necessarily income, okay? Dividends are a better way to go as long as you are owning stocks that have good balance sheets and a long history of paying dividends. Please understand the power of compounding. When you reinvest those dividends, that's where your performance is probably going to come from. Just because you give your money to an advisor doesn't mean the process is over. Stay up on the advisor. And if someone is generating what seem to be outrageous, outsized returns, they probably are fictitious and they are guilty until proven innocent. Thank you.